Hi friends, so today we are going to see about the profitability ratios of balance sheet as well as the stability ratio. Now the first important ratio is the return on equity. So this we calculate by taking the total net profit of the company and dividing it by the total equity ownership of the company. So the equity ownership is what the promoters put along with the shareholders of the company and all the reserves and surplus of the company to give us the return on equity. This can be directly derived by also dividing the EPS of the company with that of the book value per share of the company. This will also give us the same percentage. So now that we know ROE, let us jump into ROI or ROCE. So as we understand from ROI is basically return on investment or return on capital employed. So return is always net profit, but in this particular case we consider the operating profit of the company. So once we get the operating profit of the company, we divide this by the total investment made into the company. Not only the equity portion, but also the liability portion of the company. So the total equity plus the total liability, that is the loans raised from the institution, that also is being considered to finally give us the return on capital employed. This is the second most important ratio, and most of the investors typically consider this particular ratio, that is the return on capital employed. The third aspect is the debt margin of the company. So we take the total debt of the company by looking into the liability section, and once we get the total debt, we divide it by the total EBITDA. So if it is less than 1 or equal to 1, obviously the total debt can be paid off within a year itself. So these are the various types of profitability and stability ratios by using a conjunction of profit and loss as well as the balance sheet of the company. So next we jump onto the profitability and stability ratios by using the cash flow statement of the company. See you next.